According to British journalist and the environmental correspondent at the U.S. Guardian, Oliver Millman, the poorest fifth of people are paying a tax rate 60% higher on average than the top 1% of households. This disparity in tax rates exacerbates the issue of wealth inequality in America. Well, what is wealth inequality? It is the unequal distribution of wealth among people or groups within a country. However, the United States exhibits wider disparities of wealth between the poor and rich than any other major developed nation. The problem within the United States is far greater than other countries. The top 1% holds more than half of the nation's wealth in stocks alone, whereas the bottom 90% hold most of their wealth in their homes. The differences in levels of wealth across the nation result in numerous problems. According to Pew Research Center, people in the lower rungs of the economic ladder may experience diminished economic and social opportunity and mobility in the face of rising inequality. The reduced mobility causes stunted economic growth, resulting in poorer healthcare systems, lower educational achievement, political polarization, and even a lack in basic needs to lower classes, increasing rates of poverty and even homelessness.
Taxes, a compulsory contribution to state revenue, levied by the government on workers' incomes and business profit, or added to the cost of some goods, services, and transactions. Fair taxes are a staple of the American ideology and are one of the motivators that led to the founding of this country. Currently, there are 7 different federal income tax brackets: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. The income that one makes is taxed accordingly by this measurement.
U.S. tax history began in colonial times when British taxes like the Stamp Act contributed to the American Revolution. After gaining independence, tax issues under the Articles of Confederation led to the Constitution, granting the federal government tax powers. Throughout the 20th century, new taxes funded social programs, military needs, and economic policies. 21st century reforms have faced political opposition and fairness concerns as the U.S. continues to debate how to create a more equitable tax system.
Tax policies have historically favored the wealthy, allowing them to exploit loopholes and avoid taxes. A Pew Research study found that 20% of participants believed tax loopholes contributed to growing income inequality. The Tax Policy Center reports that wealthy pay an average effective tax rate of just 8% by using the buy, borrow, die loophole, which keeps wealth untaxed in assets. Addressing such loopholes could help reduce inequality. Additionally, lower capital gains tax rates benefiting the top 1% allow wealthy to accumulate wealth while paying smaller percentages on their income, taxes, and homes. The Center for American Progress argues that this preferential treatment of capital gains exacerbates inequality by enabling wealthy individuals to amass more wealth. The Chicago Booth Review suggests that higher capital gains tax rates could reduce inequality by redistributing income to public resources. Pass-through entities like partnerships and S-corporations allow business owners to avoid higher tax brackets by shifting profits to individuals, reducing corporate tax liabilities and concentration of wealth. The Stanford Institute for Economic Policy Research highlights that eliminating loopholes in corporate and pass-through income taxation would ensure high earners contribute their fair share.
Wealth inequality in the U.S. is largely driven by the accumulation of assets. The wealthiest individuals derive a substantial portion of their wealth from capital assets rather than wages. The U.S. currently has no federal wealth tax, meaning that there is no tax on total assets of an individual unless they are sold or inherited, ultimately allowing the wealthy to accumulate vast fortunes quickly. The only exception is the estate tax, which applies to estates over a certain value, which is around $12.92 million per individual, which was in 2024. For the wealthiest Americans, the tax code effectively allows them to hold onto their wealth indefinitely without significant taxation. One solution many think is beneficial is the state and local tax deduction. However, the Bipartisan Policy Center explains the opposite. BPC evaluated a series of offset options using the Tax Foundation's TAG model for revenue and economic estimates. They found that sea salt removes corporate income tax deductibility for C corporations, but allows deductions for wages, sales, and property taxes. The SALT deduction is regressive, favoring higher income individuals and worsening wealth inequality, which limits economic mobility and fuels social tensions.
Payroll taxes fund essential programs like Social Security but contribute to income and wealth inequality due to their regressive structure. A flat tax rate applies to earnings up to $176,000, with income above this threshold being exempt. This means that high-income individuals contribute a smaller proportion of their income than the lower earners. This further widens the wealth gap. For low-income workers, payroll taxes consume a significant portion of earnings, leaving less for necessities, savings, or investments, which hinders long-term financial stability. In contrast, higher earners whose contributions are capped have surplus income to invest, increasing economic disparities. Employer-matched payroll taxes also suppress wage growth. Employers consider total employee costs, including taxes, making them less inclined to provide raises. This limits upward mobility and wealth-building opportunities.
Taxes are essential for any society, but the link between corporate taxes and large companies significantly impacts global taxation. Business taxes target corporate earnings to ensure fair contribution, yet many large companies exploit legal loopholes, offshore havens, or negotiate favorable deals. The Tax Justice Network reports governments lose $245 billion annually to corporate tax avoidance, while the OECD estimates 40% of multinational profits shift to low tax jurisdictions, which drains public revenue. Additionally, corporations heavily lobby for favorable tax laws, spending $3.7 billion on lobbying in 2022 alone. These efforts often secure tax breaks and subsidies that benefit businesses but at a cost to society. As corporate tax revenues shrinks, falling from 6% of the U.S. GDP in the 1950s to just 1% today, governments return to higher individual taxes or cut out public services. This shifts the burden onto individuals and small businesses. The interplay between corporate taxation, public revenue, and economic fairness demands public awareness and advocacy for equitable policies. A fair tax system is vital to ensure no group bears an undue share of the burden.
The wealth gap in the United States has been a persistent concern, and the tax policy plays a critical role in addressing it. Progressive systems such as federal income tax, with graduated brackets, aim to redistribute wealth by taxing higher incomes at higher rates. The Earned Income Tax Credit, or the EITC, supports low to moderate income families by providing refundable tax credits, reducing poverty, all while encouraging work. Another notable effort is the taxation of capital gains. While these gains are taxed at a lower rate to encourage investment, recent debates and reforms have aimed to increase these rates for the wealthiest individuals, ensuring a fairer contribution from those who primarily earn through investments. Through these measures, the U.S. continues to refine its tax policies to address the wealth gap, balancing economic growth with equitable distribution. When viewing other countries, the U.S. has much they could learn. According to the International Money Fund, countries such as Norway and Spain have implemented wealth taxes. When these taxes are properly designed and enforced, it helps to significantly reduce the disparities in wealth inequality. This being said, according to BBC, in the UK, they are extremely reliant on their top 1% for taxes. The top 60 earners in the country pay more than €3 billion of income tax annually. This can be dangerous, as a Swiss banking giant called UBS has predicted that by 2028, the UK will lose 500,000 of their millionaires. If that were to happen, it would burn a big hole in the UK's finances, showing the high risk to these taxes. It is difficult but necessary to find the middle ground where the rich can be taxed heavily to support the nation, but not too heavily to the point of driving them out of the country.
To address the growing wealth inequality in the U.S., a comprehensive approach is necessary to ensure that the wealthiest individuals and corporations contribute a fairer share to the economy. A central element of these reforms is progressive taxation. First, raising the top income tax rates for higher earners around 40 to 45%, as well as taxing capital gains at ordinary income rates for the wealthiest individuals would create a more level playing field between income from labor and income from investment. It currently confers an excessive advantage to those earning from capital gains through its lower tax rate compared with wages, allowing higher income earners to pay a smaller portion of their income in taxes. A progressive tax structure on capital gains would offset the balance.
A wealth tax could target individuals with net worths above a threshold, such as 1 to 2% on wealth over $50 million, reducing the concentration of wealth among the ultra-wealthy. Countries like Norway and Switzerland have successfully used similar measures. Taxing unrealized gains on assets like stock and real estate would ensure the wealthy pay taxes on value increases over time, rather than deferring until assets are sold. Corporate tax loopholes such as profit sharing and offshore tax haven cost governments billions. Closing these loopholes could significantly boost tax revenue. Raising the corporate tax from 21% to 25 to 28% would also generate substantial funds without harming growth. Additionally, eliminating sea salt deductions, which would allow C corporations to deduct taxes paid on wages, property, and sales taxes, could add $395 billion in revenue in over a decade.
Currently, stock options and executive equity-based pay are taxed as long-term capital gains, allowing executives to pay lower taxes than employees. Taxing executive compensation as ordinary income would ensure fairer taxation. The payroll tax cap, which currently sits at $176,000, should be abolished or significantly raised to ensure the wealthy contribute fairly to Social Security and Medicare. Additionally, expanding on the child tax credit would help low and middle income families, easing pressure on working parents. Adjusting Social Security benefits to better support vulnerable seniors, especially those relying on the program, would narrow the gap between wealthier retirees and those dependent on these benefits for financial stability.
Effective change requires strong IRS enforcement, including the capacity to audit and collect taxes from wealthy individuals and corporations. Advanced technologies like real-time wealth auditing could help track assets and reduce tax evasion through offshore accounts or complex maneuvers. Additionally, green taxes on carbon emissions and harmful activities could fund social programs or be returned as rebates to low-income families. In the long term, wealth taxes could finance universal basic income, ensuring a minimal level of financial security for all.
One last reform would be the concept of wealth redistribution through direct equity ownership. This involves implementing a policy where every U.S. citizen receives an annual dividend or equity stake in national or public assets, similar to those used by Norway or Singapore. The U.S. government could create a national wealth fund, which would be funded by a combination of taxes on wealth, capital gains, corporate taxes, and other revenues. Every citizen would receive a proportional share in this fund, directly redistributing wealth by providing all Americans with a stake in the nation's economic growth. Over time, dividends from this fund could provide a regular, guaranteed income, reducing wealth inequality without relying on welfare or other policies. This approach would dramatically narrow wealth inequality by giving those at the bottom and middle of the economic ladder a direct claim to national prosperity.
Favorable tax policies for the wealthy, such as loopholes, lower capital gains rates, and regressive state taxes, have widened economic disparities, leaving middle and lower income households with a heavier tax burden. Public frustration highlights the need for reform. Expanding tax credits and Social Security for a lower income family, increasing IRS enforcement, and introducing green taxes can promote fairness. These reforms address systemic wealth inequality and create a more equitable tax system. By implementing fair policies and ensuring accountability, the U.S. can foster a balanced economy that supports growth and fairness for all citizens.